And that's when things fall apart. That's when the Fed has no choice to. I don't care what they say. I don't care what inflation's doing. They have to reliquify those money markets. Otherwise, you're talking about a depression that, it's an existential crisis for the nation.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 11th through November 18th, 2024, while supplies last. First, we feature backdated 1-ounce silver Austrian Philharmonics at just $3.09 over spot per ounce. We also feature the limited edition 2024 1-ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Michael Pento, founder of Pento Portfolio Strategies, is an active money manager. He watches forward trends in our financial lives and keeps his clients ahead of the game. Michael, thank you for joining us again here on Liberty and Finance.
Always interesting, and I don't think today is going to be any different.
You've often warned us in the past about shifting trends in the financial landscape, including interest rates, inflation, disinflation, actions by the Fed, etc., all of these things and how they can affect our financial lives. Right now, we've just come off the presidential election and have the clarity where we had uncertainty before about who was going to be in the Oval Office. Wondering what your outlook is on the mega trends going forward from your vantage point and what your indicators that you look at, these leading indicators, are telling you about the direction of the economy and our monetary lives as well in terms of inflation, et cetera.
Well, the bottom line is I'm looking for, in the short term, I guess more in the intermediate term, I'm looking for a little more growth and a little more inflation than I would have been if Kamala Harris won the election. And I'll expand on that. We've got a half an hour to discuss everything. So I just want to, before I forget, before I came on your program, I was listening to Bloomberg in an interview with Susan Collins, who is the Boston Fed president. Okay. And this is something that came out of her mouth. She said, and she looks like a nice woman. She looks intelligent. She speaks probably much better than I do, by the way. Maybe even looks better than I do. I don't know. But she said, if you take out food and if you take out energy and if you take out shelter, we're pretty much close to our 2% target. I mean, these are the people in charge of deciding the level of asset prices and the quality of life in the middle class and the purchasing power of your currency. We're pretty much at 2% if you take out everything you need to subsist. Anyway, so listen. As I told you in the pre-interview, and to your credit, you still wanted to have me on, I did a tactical sell in a great percentage of my physical gold. Actually, not physical. Physical gold, I never sell. But the physical gold that I have, I never sell. It's what I call liquid paper gold, which is any gold you can get through the stock market, an ETF, GLD, IAU, AAAU, miners, whatever you have. I call that liquid paper gold because it's not really gold. The only gold you really have is gold that's not a third party's responsibility to give you access to it. Okay? So that means gold in your possession. And you can never, 5% is what I recommend. You never sell that. But I sold a lot of it, and I'll tell you why. So the election of Donald Trump means to me we're going to have much lower taxes, especially since you have the Senate and the House. So much lower taxes, and you're going to have reduced regulations. That is going to be, in my opinion, is going to delay the inevitable recession. Now, on the other side of that, you're going to have tariffs, which is a one-time spike to inflation. It's not inflation. It's a one-time increase in the cost of goods purchased. And then you have deportations. And if those things happen, you might have a spike in labor costs too, as well as a depressant on the economy. But the biggest depressant on the economy that I see going forward is this inexorable rise in interest rates. I mean, the Fed cuts rate. the Fed, in their omniscience, decided in an emergency move, not trying to elect Joe Biden, I'm Kamala Harris, in an emergency move to cut 50 basis points in September. And now all of a sudden they're saying, well, maybe we don't have to cut it all. Maybe we're not in a rush to cut. I really am racking my brains trying to figure out what exactly changed, because the data was strong in September. But they cut by 50, and they cut again in October by 25 basis points. But I think interest rates are going down in the Fed funds rate. I think that's inflationary. Deregulation of banks is very inflationary. You have the king of debt and the lover of a weak dollar coming into power again, correct? And the most important thing I can tell you is that the Treasury solvency is, or I say the Treasury's insolvency, is a condition that we all should be aware of. And that could spike interest rates very high on the long end of the yield curve. And that could bring this whole thing down. And my model's, myopically focused on that. So yes, the chances are stronger growth. Chances are we're having higher inflation. But you have to keep a keen eye on the functionality and liquidity in the credit markets and the money markets and in long duration bonds. And that's what I'm focused on, because that's the warning sign to everything's going to fall apart. The economy and the market. And so you have, in other words, Dunnigan, if you're a passive 60-40 target date fund, closet indexed, passive indexed, like everybody else is, you could get slaughtered. I don't know when. Could be sometime in the later half of 2025, but you could be slaughtered. Could be sooner than that. But we still have, I'm wrapping up here. I know I'm rambling for the introduction question. We still have massive asset bubbles in credit and in real estate and in equities. It could get even worse going out in the next couple of quarters. So that has to be reconciled, and it will, and it's going to end very badly. So parenthetically speaking, I sold the gold as a tactical maneuver, but in the long run, it's going much, much, much higher.
In passing there, you mentioned the Fed's half point and quarter point interest rate cuts, and yet higher longer term interest rates going forward. Can you explain what your view is of that? If the Fed only has control over the short term rates, and yet the yield curve is going higher in the in the 10-year, et cetera, what does that mean to you as an economist?
Well, it means that growth, that's a depressant on growth. That's going to be that's offsetting some of the tax cuts and deregulations you're going to have. I mean, we still have a tremendous amount of debt. The household has a record amount of debt, not as a percentage of GDP. That's come down from 100 to around 70%. But 70% household debt to GDP is very high. We have a record amount of corporate debt. We have things like private credit out there, which didn't even exist before. Trillions of dollars of this stuff. Commercial real estate. These are all things that are affected by higher interest rates, and higher interest rates are going to be a massive depressant to offsetting what I just mentioned, the Trump election. And it could get out of hand. It could spiral out of hand because, if you have, and this is the three reasons why, these are things that Powell and Susan Collins, who, we're data dependent. Well, you're data dependent. I just wrote a piece called Driving the Interest Rate Vehicle with Your Feet on the Steering Wheel and Your Eyes on the Rear View Windshield. That's what they're doing. I mean, they're making decisions about interest rates that should be based on a free market. It should be based on a gold standard. They're making decisions looking at data that is lagging and faulty. The data is faulty on what? The labor market. That's how they're making their decisions. In my opinion, we should have a money supply that's dictated by the mine supply of gold. That's the base money supply. You should have a fettered fractional reserve system where you can't go out and just monetize debt willy-nilly, but that's what's going to happen. You're going to have the banking system, both shadow and traditional, FDIC insured institutions, monetizing trillions of dollars of the federal debt, which is going to be bought by Jerome Powell. He's going to be forced to do it. The average interest rate on U.S. debt is about 3.5% right now. There isn't an interest rate on the yield curve. You go from Fed funds all the way to the 30-year. It's much higher than that. So the interest on the debt, which is already $1 trillion, is going to go much, much higher because the debt's going higher and the interest paid on that debt is going much higher. We're already paying 20% of interest. 20% of all revenue is going to pay interest on the debt. That would be 30% today if we had interest rates normalized. I mean, if interest rates stayed where they were and we just, kept on floating T-bills. So why are interest rates rising? Inflation, insolvency, and illiquidity. That's why you'll never hear Powell or Susan Collins talk about that. That's the real problem. And that's what you have to monitor if you're investing in the stock market. And I am. I'm still not sure. Then again, I am still not short yet. I'm waiting. Financial conditions continue to ease. Credit spreads remain very tight. And we have the promise of lower taxes, much lower taxes. Across the board, on corporations, on individuals, Social Security, taxes and tips and everything. I mean, he could get a lot of this passed. I don't know how much he's going to get passed, but he could get a lot of it passed. And deregulation is going to be massive. So you're going to get a big increase in money supply. So inflation is going to be much higher than I thought it was going to, or not that I thought, than what it could have been under a Harris regime. So you got to watch the credit markets, and that's going to lead you to a path of, being able to invest responsibly and carefully in this bull market that continues, or to get completely wiped out. This could be a 1987 event. By the way, Jonathan, do you know the total market cap of equities? This is Warren Buffett's favorite indicator, and it's my favorite indicator too. The total market cap of equities as a percentage of the underlying economy in 1987 was October of 87. Do you know? It was 60%. Do you know what it is today? It's over 200% of GDP. That tells you how incredible the bubble is in equities. And that's why, like I said, if you're just and everybody's in it, there's a record amount of investors that own stocks right now. A record amount of household net worth is in the stock market. And they're all crowded into the same few stocks. When that unwinds, it could be catastrophic. I mean, in 1987, we lost 23% in one day. That can't happen again. And the reason why it can't happen again is because we have circuit breakers, right? 7% down, we close down for 15 minutes. And then we go down 13%, there's another 15 minutes. And if you close down 20%, we shut the whole thing down. But does that make you feel like, does that give you any solace? No. I mean, really. I mean, no. So the operative word here is caution, stay alert, have a model that works and monitors the credit markets, because you could get slaughtered even though things look okay right now.
So if I can summarize what I'm hearing from you, for an ordinary mom and pop retail investor who's trying to hold things together, either building a retirement or keeping their retirement afloat, it's not the environment that we were in for the past 40 years is not what you're describing here. You're describing an environment that takes extreme vigilance, because even though we're in what may be a continuation of the bull that appears on the surface to be back to business as usual, there are a great systemic instabilities underneath there, or risks that means things could turn on a dime. So either someone needs to, in other words, just as you said, just being parked in a 60-40 or ETF type index shadowing buy and hold is going to leave you at an unacceptable risk to people who are late career stage or retirement stage. So they either need to have someone who's a very active money manager like yourself watching things like a hawk for them, or consider other safe harbor options that would still get them through time of high inflation at lower risk. So it sounds like it's a time of complexity for ordinary investors, and probably daunting for most people who don't have their fingers tied into all the streams of forward-looking information that you keep an eye on.
Donegan, it was very well summarized. Thank you. What has the Fed inculcated to the market since 1987? And we got you back. We will print money very quickly and in humongous proportions. So what does the Fed do? It creates something called Fed credit, right? It's part of the base money supply. It's reserves. And they printed trillions upon trillions after COVID, after the collapse of the global financial crisis. They started this practice in 1987 after the crash.
Yeah, and it just remind me there, because I have a vague memory that back at that time we were told it was going to be a $400 billion bailout of the banking industry. Oh, then it would turn on to $800 billion. Then by the time the tab finally came back from the waiter at the end, we were told, oh, maybe 16 to 21 trillion, give or take. Am I wrong about that?
So the base money supply was prior to the GFC. That includes everything. The Thai baht crash, Russian crisis, 2001 debacle, everything. 87 the Fed's balance sheet, which is high-powered money, basically representative of high-powered money, represents the base money supply, the building blocks of all monetary aggregates, was $700 billion. That base money supply went to $9 trillion post-COVID. It was $4.5 trillion prior to that. Jerome Powell printed $4.5 trillion for what turned out to be only like a slight decline in GDP, I'm not going to say I'll say an exaggerated crisis, a health crisis. Okay, exaggerated. It wasn't nothing. People died, and I feel terrible for them. But it wasn't, it wasn't the end of the world. It wasn't the bubonic plague. We can agree on that. Okay, I hope. But they've shown a willingness to expand that balance sheet willy-nilly in a nanosecond by trillions of dollars, and they're going to do it again. And who's going to buy all that debt? I mean, where's it going to come from? It's going to come from the Fed is going to create credit, and private banks are going to go out and buy it all, and that's massively inflationary. So it's a tactical trade. I sold gold because gold doesn't like when growth and inflation are accelerating. That is what I expect to happen because there's other alternatives. You can buy stocks when growth is accelerating. Bond yields are going higher. So that's an alternative. It's competition for money. Gold is real money. But that process could end in an absolute disaster once you get a freeze in the credit markets, and then you could have a wipeout of everything. And then people will be, oh my gosh, we're going back into helicopter money? Really? And I wanted to just button up that point because from 87 to the global financial crisis, even to the COVID crisis, the Fed came to the rescue by printing, like we just talked about, trillions of dollars. Because the problem was what? It was, we had disinflation, we had deflation. We haven't had a problem with inflation since 81. Well, now we've got a problem with inflation. And now we have insolvency in the treasury market. So what you're saying is that the Fed put what people are saying is Wall Street, not me. Wall Street's telling us, well, the Fed has your back. They've inculcated this over and over again. The Fed has your back. In a problem, they will print trillions of dollars. But what if they print trillions of dollars when the problem is the salient issues are insolvency and inflation? They're going to just make the situation much worse, right? So you could have negative real interest rates, profoundly negative real interest rates, even though nominal rates are spiking. That's the best environment for gold. So gold likes two things. It likes recessions because nominal rates are falling. Generally, real interest rates are falling. There's less competition for other assets because who wants to buy a house or a stock or buy bonds, short-term bonds when the rate's coming down? You buy gold, right? And gold loves stagflations because that's when you have no growth or negative growth and you have high inflation. So how do you keep ahead of inflation in that scenario? You have to buy gold. And that's what I think we're headed in the long term. So again, I said it, this is the third time. I won't have to say it again. It's a tactical move for those active managers. But if you're not worried about short-term moves with the gold price, then stay where you are.
The crisis that you've hinted at a couple of times here, or not hinted at, you've stated that is likely in the cards, this liquidity crisis in the credit markets. Can you explain what that means to the ordinary person and how you see it happening?
It wouldn't be dissimilar than what we saw in 2019 or even in the GFC. So you can't float commercial paper. Money markets drop below the $1. There's no liquidity. Nobody wants the repo market freezes. So nobody, even repo as a collateralized lending. Nobody trusts the institution that's lending them treasuries. I mean, that's happened before, and I think it's going to. In fact, I can't guarantee it, but I'm very confident it's going to happen again. And that's when things fall apart. That's when the Fed has no choice to. I don't care what they say. I don't care what inflation's doing. They have to reliquify those money markets. Otherwise, you're talking about a depression that, it's an existential crisis for the nation. If you can't float commercial paper, if the liquidity dries up and there's repo markets frozen, nothing works. No lending, zero lending in a fiat currency system means that the economy goes to zero. Forget about a recession. You're talking about a trenchant and powerful depression. So no, there's no choice. That's what they're going to do. And that's when you're going to have to, if you're in that 60-40 buy and hold portfolio, boy, oh boy, it's not funny.
A lot of people, maybe even most people, retirement age are using retail financial planners who have them in a 60-40 portfolio, or they heard that on the news enough times that they said, I guess I'll just go do that myself. If they have any investment in the equity market, some don't, but many do, through 401ks, through IRAs, through all kinds of things. For people who are in that situation and know that in their gut, they're not going to be able to keep their eagle eye on this, or they wouldn't even know what to watch for to know that the warning signs before it gets announced that, oh guys, guess what guys, it's all come tumbling down and too bad. One option is have somebody watch it for them, and that's where you could come in. Can you tell people about what you do and how they could use your services?
So there's two things that you could do for me. One is like a 36,000 foot level. I could tell you there's, the problems here and you need to do something about it. And I'll give you some very broad strokes in my midweek reality check. That's published every Wednesday. But if you want to know specifically what to, and by the way, that's a $50 a year, and I give a fee with a 5-week free trial. And, I don't know, $50 to really understand what's happening in the stock market and the economy seems like a pretty good deal to me. But anyway, if you want someone to watch your money on a daily basis, a minute-by-minute basis, and specific, I do all the trading for my clients. My money's there, and my client's money is in the IDEX strategy, inflation, deflation, and economic cycle strategy. If you have $100,000 to invest, and you are a U.S. citizen, I will trade that for you, so you can avoid, God willing, the massive declines that could come from a credit crisis that we just talked about. And the solution to that credit crisis would just be more inflation, which could do nothing but send yields even higher. Unless, of course, the Fed decides to buy everything. They could do, not just buy the interbank lending rate, the Fed funds rate. They could actually go out and buy treasuries, long-term treasuries, which is that's what Japan does. It's entirely possible. But what about corporate debt? What about municipal bond? Are they going to buy all that debt too? Because, if you, let's just say a thought experiment. I mean, if inflation's running at 20% per annum and the 10-year treasury note, since all their buying from the Fed is sent them to like 8%, just pick a number. But they're not buying any municipal bonds. What would municipal bonds trade at? And is the Fed going to commit to buy every single fixed income product out there? And if that's the case, where does inflation go? And how does an economy function? You're talking about, Zimbabwe, if that happens. So, I mean, do you want to hold utilities and stock investments in that portfolio? No, you'd have to adjust it to own equities that tend to outperform inflation if you're going to own equities at all. So that's the kind of thought process that I have with my inflation-deflation model.
Well, Michael, you always help us to see things in a forward-looking view through indicators that we're not hearing about. I mean, the stuff you talk about is so impactful to the direction that things are going, and yet it's not what we're hearing about on the financial media. In fact, I think you've been disinvited from speaking on the financial media because you don't toe the line. You call them like you see them, and we appreciate that. And so do our viewers and subscribers.
Susan Collins, today, inflation isn't now. and I don't want to go over time here, but I just say inflation has wiped out the middle class. It was responsible for the election of Donald Trump. Okay. That was the primary reason, that and probably the weaponization of the Justice Department. But inflation, minorities voted for Republicans in droves because their purchasing power has been destroyed. And the fact that inflation is above the Fed's target, rising, you're going the wrong direction. It's actually rising from 2.5% and going higher. And Susan Collins says, well, if you take out like the stuff that you need to live, like energy, food, and shelter, oh, we're good. This is how out of touch they are and how dangerous they are. So protect yourself. Get smart.
Michael, we're always grateful, all of our subscribers and viewers, for your visits here with us on Liberty and Finance. Folk, if you don't want to miss a single episode with Michael or any of our other guests, make sure you're on our free mailing list. Just go to libertyandfinance.com, put in your email address, click submit, make sure you confirm. On the confirm email, you'll get one email in your inbox per day with our latest interviews, including all of our interviews with Michael and any of our weekly specials. Michael, as always, on behalf of all of our viewers and subscribers, thank you for joining us again on Liberty and Finance.
Blessings to you, Donegan. Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 11th through November 18th, 2024, while supplies last. First, we feature backdated 1-ounce silver Austrian Philharmonics at just $3.09 over spot per ounce. We also feature the limited edition 2024 1-ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.